We delve into the first stock of the evening. Insurer MMI reported core headline earnings per share at 163 cents in the year to the end of June, compared with 134 cents a year earlier. Full year earnings were up 22%, helped along by new business volumes. The group declared a total dividend of 105 cents per share from 63 cents a year earlier. Of course, a market cap of 25 billion rand, dividend yield of 5% and a PE of just under 12. Let's start off with you, Chris. MMI, of course, the merger between Metropolitan and Momentum, and we keep talking about the cost savings that we could be seeing coming through for the company. It seems that now they're looking at 500 million rand. I was speaking to Andrew Ditburner from Cannon Asset Managers a little earlier. He's not convinced. He says it's well below that level.
Yeah, and look, I think the essence of this whole thing is we have to wait and see. Only time will tell. Whether you get those kinds of cost savings coming through, because you don't always. I mean, the best laid plans of mice and men really can sometimes go awry. And secondly, whether you in fact get the kind of smooth merger that they're looking for. At the end of the day, in my experience, there's no such thing as a merger.
I've actually heard that before. Andrew Ditburner also pointed that out.
You've always got a larger company acquiring something else.
Yeah.
Conceptually, it looks very good indeed, in the sense that you're putting lower end of the market. No insult intended there, but that is their niche in Metropolitan, and middle to upper end of the market with Momentum, and the end result should be very synergistic for both concerned. But as I say, I think it's just a little bit perhaps too early to make any kind of real prognostications about what's actually going to happen, certainly on the basis of this set of results.
Johnny, welcome to the program. Let's get a sense from you, because actually we had a bit of a conversation a little earlier today, and you were also pretty much perplexed, or looking at the number between 500 million rand cost saving to the initial numbers that they'd actually put on the table of between 500 million rand and 750 million rand. Are you content with this cost saving number, and are you convinced that they can get it right?
Well, I think there were three issues with the results. The first, as we've sort of spoken about, was the cost savings. And I think the problem with mergers is that investors and analysts try and sort of discount what the cost synergies could be. And generally, those cost savings, always take a lot longer to come through than expected, particularly in this case, as the Competition Commission has hamstrung MMI in terms of the number of retrenchments that they can make. But also, often you have to actually incur costs to actually get the cost savings, and that's likely to hurt MMI in the short term as well.
Well, do you also agree? I mean, we spoke about mergers and whether there are in fact any mergers. We always see someone acquiring someone else. Who do you think has the upper hand at this point?
I think marginally the Momentum team. I think it was sort of a reverse acquisition. Mergers are never easy, although I'd argue that the Momentum team has probably gone through more live mergers than most management teams. You may recall they did Sage a while ago, and prior to that Southern as well. So they do have sort of a lot more experience than other management teams.
Johnny mentioned the regulations, of course, with regards to the Competition Commission and adhering to them until that process and that period is over. Do you think that they need to, at this stage, cut down on staff? Is that what's holding them back?
Only they can really answer that. But I mean, I was talking to one of my colleagues who went to the presentation today. He said, now, and I may have got this wrong, Johnny can maybe put me right on this one, but there's going to be something like 22 analysts in the enlarged asset management side of things. That's an awful lot of people. And okay, it's an enlarged asset base, obviously, but are there genuinely going to be enough employment for that? I don't know. That's just to use one example. At the end of the day, if you're going to get cost savings, where are they going to come from? You're not going to get it by saving a few desks here and there. Unfortunately, usually, in my experience, it does come with a lower headcount over time. Yeah. So yeah, look, I don't know. Only time will tell.
Okay, so let's get comment from you on that, Johnny, and what your sense is. Do you think it is about headcount? And as Chris alluded to, it seems that they are increasing their headcounts in certain areas, and we know Momentum Investments is actually dismal performance relative to the other divisions.
Correct. I mean, look, the headcount is an issue. I think Metropolitan was always deemed to be almost the employer of last resort here in Cape Town. I think they used to have a staff complement, around about 8,000 people, which was almost double what Momentum had. Arguably, Metropolitan had a lot more administrative businesses and hence a very large headcount. But that will have to be rationalised over time. If you compare the life company's cost base relative to somebody like Coronation, the life codes are just off the scale. They just carry too much cost for the amount of new business that they're currently writing. They have to really rescale their businesses downwards.
When you look at the total assets under management in the previous period, we're looking at 424 billion rand. We're now looking at 275 billion rand. We've seen quite strong outflows coming to the fore, and it's not something that we have actually seen overall in the market. Johnny, are you convinced that they can turn this business around? I spoke to the CEO a little earlier today, and he was saying that this is the bottom of the cycle, and they are expecting to see a better performance going forward.
I think it will take time to sort of turn the outflow situation. I mean, I think they lost about 15 billion on the momentum investment side, and hopefully they'll start to sort of stem that. And then, thankfully, at least the life business is still cash flow positive, so the total assets under management should grow quite nicely this year.
Chris, what is your sense with regards to the National Health Insurance scheme possibly could be occurring in the country, because it seems that it was an underlying theme within the MMI results, and they're saying it could be an opportunity and it could also be a challenge. I did ask the CEO if they are starting to gear themselves up for that. He was talking about private-public partnerships. What is your sense? Do you think that the overall insurance space in South Africa should actually start putting strategies in place to cope with regulatory changes?
Yeah, Lenny, make no mistake, it's going to happen at some point in time. The only question is it going to be 14 years as has been envisaged, or is it going to be longer? I think given and there are many ways you can look at this, but I think given the very, very small size of our tax base in this country, it may even take longer than that. But having said that, coming back to your question, is it going to be a private-public partnership? Of course it is. I mean, there is no way in this world that the government can handle something of this enormity, given the kind of relatively grandiose vision that they've got for the whole thing. So yes, is momentum going to be involved? Is discovery going to be involved? I mean, you talk to them, it looks like they would love to get involved in something like this with their undoubted administrative capabilities. So I think you're going to have quite a lot of the companies in that space champing at the bit and looking to get some sort of business out of it. Yeah.
Hot or not for you, Chris?
No, not hot in the slightest. And I don't mean that in a derogatory way. Look, we don't have life assurers in our portfolio because at the end of the day, in many ways, they're just a proxy for the market. And it's something that we tend to think we can do better than insurance companies.
Okay, so what do you do to get exposure to that kind of market, if at all?
Well, as I say, we are a high net worth individual business in our own right, and we take the view that we can probably do better than some of the big boys.
Okay, so for you, Johnny, hot or not?
Not at these levels. I think the market originally discounted too much into this merger, and the stock re-rated relative to its embedded value. It probably trades at about a 13% discount to embedded value. If you want to be in the sector, you could probably buy Mutual, and a 40% discount seems to have far more upside than MMI.
All right, let's delve now into the next stock. Remgro, the company, is expected to report next week. The company says that headline earnings per share for the 15 months to the end of June could be between 50 and 60% higher. Now, this is due to the extension of the financial reporting period by 3 months. Johnny, let's kick this stock off with you. And we're talking about a possible 60% increase in headline earnings per share. I did allude to the fact that we've seen the financial period extended by 3 months. What kind of alteration have we actually seen within that headline earning per share number, because it's looking very strong at this stage?
Yeah, as I mentioned, I think when I was on the show last week, the HEPS number is going to be distorted by the fact that you're comparing a 15-month period with a 12-month period. We're slightly more interested in the dividend that is likely to come out of Remgro. They paid a final dividend last year for the 6 months of around rand 25. We think they could pay a R2 final dividend. And then if you look at the dividends that are coming out of FirstRand, including the special dividend yesterday, RMH this afternoon and their special dividend, and RMI, which Remgro has stakes in all those three companies, they're going to net another about 1.1 billion rand from all those dividends. If they decide to pass that through to the Remgro shareholders, you've got another R2 special dividend as well. So potentially a R4 special dividend out of Remgro. And the company still sits on a very large cash pile.
Well, it has a dividend yield of 2%, a PE of 6, and market cap of 54 billion rand. And I know that it's one of the most interesting stocks for you, Chris, if I'm not mistaken.
Yes, very amusing.
And I say it with a sarcastic tone, of course.
Slightly sarcastic, yes. No, we had this until about 18 months, maybe 2 years ago, and we decided to rationalise a lot of our Rupert Company stocks. We had Renette as well, and we pretty much consolidated it largely into Richemont. because we took the view that Richemont is a better play in terms of it's a much more streamlined operation altogether. Look, Remgro, don't get me wrong, there's some really nice companies in there. I mean, Unilever South Africa, almost 26% of that. There's some great operations in there. But at the end of the day, ultimately, it is a conglomerate. It's an old-fashioned industrial holding company, which will invariably sit at a discount to its NAV. And it's going to hang around there. It'll be a widows and orphans stock, I think, in perpetuity.
Because you get interesting exposure here. You've got Distel, you've got Total South Africa, 25% stake, Seacom 25% as well. And I think Johnny hit the nail on the head when you look at the special dividend process that could actually come to play here. Are you also looking at that? Would you be looking at that, given the fact that many of its holdings have embarked on a special dividends this reporting season?
Absolutely. And look, they're changing their year end to be in line with one of the biggest holdings, which is RMBH stroke First Rand. But yeah, from the longer term perspective, it's all very well, to get a dividend and a whole bunch of dividends at this point in time. But longer term, I find it very, very difficult to get excited about this stock.
Johnny, does this stock excite you in the least? I mean, Rainbow Chicken holding of 73%, Mediclinic 45%, Unilever about 26%. It's well diversified.
Look, it's a very well diversified company. I mean, we like it. It trades at about a 20% discount to its underlying NAV, and I tend to agree with Chris. It will trade at a discount. It's obviously just what discount it will actually trade at. If you look at the unlisted operations, and we've talked about Unilever, TSB, Sugar, etc., and look at the multiple that Remgro is effectively valuing those unlisted counters at, you're looking at about a P of about 10, which is a discount to the market. So, we think there's value in those unlisted businesses as well, which the market's probably not properly valuing.
Oh, exactly. I mean, we do have exposure here to unlisted businesses. I alluded to them, Total and Unilever, and the likes of Seacom as well. Do you think that they should start increasing their exposure to the unlisted space? Is that what's going to differentiate them within the market, Johnny?
It's one of the strategies that they are contemplating. I mean, Remgro does tend to move quite slowly. They are sitting on 6 billion of cash as of today. Once those dividends flow, they'll have about 7 billion of cash. That's about 10% of their market cap, which they could definitely deploy into other investments. Given their size, it is obviously quite difficult for them to find large investments that will change the NAV component, but there's definitely a free option there that the market's not pricing.
And the truth is they're doing quite well without the BTI holding as well, and they have sold underperforming stakes in Nampak, for example. So it seems that they are very much hands-on. They're not sort of sitting passively and looking at their portfolio.
No, make no mistake. This is a great company, and it's been around for many, many decades, and it's going to be around for many, many more decades to come. And as Johnny says, there's great value in there, without question. The only question is, how is that value ever going to be realized, for the shareholder? Yes, you get some nice divvies, and that's why I say I think it's more of a widows and orphan stock, where you're going to get this good dividend flow.
I thought conglomerates were out of fashion since the 80s, actually.
Yes, well, precisely. It's the wrong type of place to be, I think, unfortunately. But it's a great company, incredibly well managed. I remember back about 12, 13 years ago when they collapsed the pyramids. Used to have pyramids like Tib and Tech and Rembrandt Beheerend and stuff like that, and a bit of value was created when that happened. You just got the one operating entity coming out of it, and but I struggle to see how you would get a similar thing happening in the future.
What do you think they need to do to change the perceptions of Remgro? Because this is not the first time that I've heard this rhetoric coming through from investors.
It's very, very difficult, as I say, because industrial holding companies, conglomerates, do around the world tend to sit at a big discount. I mean, Johnny said 20% discount to NAV. And that's the problem I've got. How do you unlock that? I don't know.
Hot or not for you, Chris?
Certainly not.
And Johnny, are you hot on Remgro?
We like it as long as they continue to pay dividends, so we don't mind if it continues to trade at a discount.
Do you hold Remgro?
Yes, we do.
Johnny, okay, fantastic. We're going to a very short break. After the break, we look at the JD Group as well as get our guest Hot Stock picks. Don't you go anywhere.